Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about frequently asked questions during this bear market. Tyler and I hear a lot of questions from our own clients, and we also hear questions from other investors out there that, during this volatility, some of these questions we hear each and every year. Some of these questions we only hear during this most volatile time. So we're going to talk about some of the questions we hear and answer those. The first one that we're going to talk about is, and this one is very common, and we hear it quite often, and that is during the bear market like this, when the market's down anywhere from 30+% to maybe 8 or 9%, depending on what stage of this market we're talking about, should I change my investments so they're more conservative? And really, you need to look at this and understand that conservative doesn't always mean safe. We brought this up in the past. People use the word, my portfolio is safe because it's conservative. That's not necessarily true. Conservative has some features that typically get you a lower rate of return, but you're not taking on the volatility. So understand that conservative isn't safe. Safe, if you want safety, put it into cash or don't invest at all. But you have to be cautious. Many times, I know Tyler actually has a client that he talked to a couple of weeks back when we were seeing pretty significant volatility. And what had happened is she had a portfolio. It was actually her 401k, so it was outside of any of the management we're doing here. And she had a 401k that went down pretty substantially. And as it got down to a significant downside of 22%, she moved out of the equity positions or the mutual fund positions that were built on equity and went into bond and fixed positions. Well, now she pretty much sealed her fate that the recovery is going to be significantly slower than the market. So here's where either a lack of experience or just emotion comes into play. The market goes down, you feel uncomfortable. So finally, at some point, emotion kicks in and you say, okay, I got to stop the bleeding. We hear that. I've got to stop the bleeding. So I go into a more conservative position. Wrong thing to do at that point. Okay, before the market goes down, to build up cash is a good thing to do. Always have cash on the sideline, as some investors call it, dry powder to be used. But the thing you don't want to do is go into more conservative positions towards the bottom of the barrel because, again, your recovery is going to be significantly slower. Anything else on that, Tyler?
Yeah, Dean, so when we talk about frequently asked questions during a bear market, one of the ones that we've been getting a lot lately is if people should change their investments so that they're more conservative. And with this, it really is, you have to pay attention to the time when you do this, and obviously this is something that if you're nearing retirement or in retirement should have been done well before the time period that we're in, because right now we're in mid-April and obviously there's been a lot of volatility in the stock market. A few weeks ago the market had bottomed out. It was down, the Dow was down about 35% from the beginning of the year. Right now it's down anywhere from 15 to 20%, so it has bounced back a little bit, but who knows what to expect coming up here in the future. And that's where right now would probably not be a great time to move everything more conservatively. You don't want to do that. You don't want to sell off into the teeth of weakness. You want to make sure that you can ride this thing out, and then once the market does recover, and no one knows exactly when that's going to be, but that would be the time to reevaluate your risk. And if you weren't happy with the losses that you took during the downturn here, then when the market recovers, it's time to go and switch around your asset allocation, meaning that you might be better off in higher bond and or cash allocation when the market's doing good, meaning that you're giving up more upside to not have as much downside for the next time this were to happen. So again, right now probably isn't the time to make adjustments and go more conservative because your recovery is going to be that much slower. However, once the market does recover even a little bit more, then it might be the time to reevaluate and go more conservative if you can't handle the risk that you just did with this recent market downturn. So again, now probably isn't the right time to shift everything conservatively, but in the future, once the market does recover, it very well likely could be time to reevaluate and do it when the market is higher.
Okay, good points, Tyler. Next one we're going to talk about is, we hear this one actually quite often also, and that is, should I stop contributing to my 401k or IRA during a bear market? The obvious answer is no. We don't want you doing that at all. And part of the reason is you are dollar cost averaging. Most people are familiar with that term. What that means is you're able to buy significantly more investments at a lower cost, and that's a good thing. Buying low is a good thing when it comes to investments. So hypothetically, let's say you have $2,000 that's going into the market when the market's high, in shares within your 401k, let's say are $25 per share. Well, that same $2,000 going in a bear market, when that share instead of $25 is worth $15, you're buying significantly more shares at a lower price. So that's very, very, very important to know and understand. So should you cut back on your 401k? We recommend you do not. Tyler, what about examples of where we do tell people to cut back on their 401k?
Yeah, Dean, very good point there. Now, before I get into the examples where it might be a good point to cut back on your 401k, for those people who have adequate cash on hand, a good emergency fund, for those people that have minimal or no debt, then one thing that I think that they should look at would be buying in right now, continuing to buy in, continue to have your 401k work as it has been, where you're dollar cost averaging every single paycheck, have the money go into your 401k. However, this is I joke around, this is the one time where those people who are asking if they should stop contributing or not contribute during a bear market, when the market is beaten up, when it's at a low point, it's one of the few times that I hear people complain about buying something on sale. Usually people like to buy things on sale, but whenever you're talking about the stock market, it's one time where there's people that have questions about it. But yeah, now is a great time because you're buying more shares at a low. If you buy more at a low point, it gives you a quicker chance at recovering. So we definitely do recommend not stopping your contribution, but continuing to contribute to your 401k, your Roth IRAs, your retirement accounts. However, the one time where you might want to consider cutting off contributions would be if you do have significant debt or are borrowing money to make ends meet. So that's where, instead of putting money into the market during this time, what you probably want to do is stockpile cash and pay down debt before you try and buy into the market at a low point. Because again, we want to make sure that your debt situation is taken care of first and foremost before you try and time the market and get money into the market. But for those people who have their debt paid down, who have an adequate emergency fund, and who have stable jobs during this time, then for those people, you want to continue to contribute to your 401k, or if you can even afford to increase your contribution, that might be something to look at too, where those people who can actually put more in right now would be the perfect time to do so. So ultimately, do not stop contributing to your 401k during the bear market. This is actually where you might want to increase your contribution, or at the very least continue to keep it on automatic, and every single paycheck have that money continue to go in there, because again, you're buying more shares at a low, you're going to recover quicker by buying in low.
Okay. The next one we hear quite often, for those people who are actively investing yet, they will ask, should I put money in and start to buy stocks that are down the most? And this is a tough one, and not making personal recommendations, but just in general. Here's a scenario. In 2019, we ran across an investor who wanted to buy everything he possibly could as low as he possibly could. So he was picking up what we refer to as the dogs of the Dow or the dogs of the S&P, meaning that their performance was down pretty substantially. So therefore, if you're buying them at a low, chances are and your hope is that they will increase the most. Well, what happened is 2019 was one of the best years in the stock market. The market went up substantially, but they picked a lot of value and distressed companies that had significantly low stock prices compared to their all-time highs. So they didn't perform well in 2019. And then lo and behold, in 2020 so far, because the market went down across the board, those stocks went down even further. So to just go in and bottom fish or bottom feed with these stocks is typically not a good thing to do. We still believe in diversification, even when it comes to your single portfolio. You can diversify pretty substantially within one portfolio. We believe in, if you're going to take that approach, for every handful of stocks that you buy at historic lows, do look at some momentum stocks. Some of these stocks that did well in 2019 and also are doing well through the pandemic and the bear market of 2020 have significant momentum. That's what we refer to it as, momentum stock. They're creating momentum in an upward trajectory, okay? So when we look at those, there are things such as Amazon and Walmart and Costco and Dollar General and Clorox were doing well prior to the pandemic. They continue to do well through it. Those momentum stocks should be brought into the portfolio, as well as some of those dogs that we're referring to, dogs of the Dow or dogs of the S&P. You want to stay diversified. You don't want to have your portfolio slanted all towards growth momentum stock. You don't want to have it all towards value stocks that are on their 52-week lows. Tyler, what else when you talk about, should I buy stocks that are down the most?
Yeah, this is a question that we have gotten a lot lately, and it does make sense from a common sense approach when you think about it. You want to buy low, sell high. So if you think about it right now, you want to buy stocks that are down the most. So that could be companies that are in the oil, airlines, or cruise line sectors. However, if you go and do that, and I actually have an example, there was a client who had $20,000 above and beyond their emergency fund and savings that they wanted to invest a third in oil, a third in airlines, and a third in cruise lines. And if you're doing that right now, then you're trading, you're not investing. And part of the reason why is because, sure, you're hoping to buy in low, and then they're going to come up a little bit, just simply as the stock market rises, they are going to come up, but then you have to continually monitor them because the airlines and cruise lines industry, it's going to take quite a bit before they get back to what they were a couple months ago, just due to this whole virus pandemic. So that's something where instead of investing in the dogs, the companies that are beat up the most, what I like better is companies like technology or healthcare, for example. We have this whole work-at-home economy where now a lot of people are using technology to interact and to work. And that is what we expect over the next couple quarters through 2020 and then basically the next decade or so into the future to really drive the market and to rebound the quickest. So that's where I would rather invest over the long term in different tech and healthcare stocks and maybe even some consumer staples or retail, as opposed to cruise lines or oil or airlines, because they will not have the prolonged recovery. And for those people that buy them right now at a low, most of those people are going to be selling them within a couple months before the stock goes back down again. So that's no, and I'm not saying to not have anything in there. There's people that sure take 10, 15, 20% of whatever you have to invest right now, and you can put a small percentage in the dogs, the companies that are beat up the most. But Dean, as you said, it's always good to diversify. It's good to have some in the dogs, as we refer to them, the ones that are beaten up and that are down the most. But then right now we also like having a good portion in momentum stocks as well, companies that have done really well through 2019 and that have held up pretty well into 2020, just because we expect them to recover a lot quicker and more so than some of the sectors that have been beaten up due to this whole virus.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about withdrawals. Should I cut my withdrawal? This is a tough one because as we tell people, prior to the market going down so substantially, if you have expenses that you can cut, we would rather see you cut those expenses first, then we'll look at the withdrawals. If you truly have nothing to cut at all, as far as expenses, cutting your withdrawal is going to be hard to do because you need to make ends meet. So let's first look at expenses. Go in, scrutinize those. If you had expenses prior to this market going down that were fringe expenses, look at cutting those. Then cutting back on the withdrawal is going to be easy to do, and it's going to be able to help you out going forward. But cutting withdrawals, if you have to use the 100% of the withdrawal, there's no additional expenses in there, you need to keep it going. Your portfolio should be made with a combination of investments to be able to account for that withdrawal should the market be up or down. Typically, when we put together financial plans for our clients, we'll look at an average, we'll say that what happens if the market only gives you a 5% increase for the rest of your life. And a client will say, well, my portfolio should do significantly better than that. Yes, that's right. And we hope it does, and we'll manage it that way. But what happens if you only have a 5% each and every year for the rest of your life? Will your financial plan hold up? That's how you need to look at it. It needs to be a worst case scenario, very conservative situation. We've had people come in already and say, well, I want to look at my financial plan based on, a 10 or a 15% rate of return. No, that's fictitious. That is never going to hold up, and we won't do it. Tyler, anything else as far as, cutting withdrawals?
Yeah, Dean, just that we do recommend cutting your expenses and cutting your withdrawals, especially if you are withdrawing hefty from a stock market account, because the last thing that you want to do is withdraw and sell shares at a low point when the market is beaten up, when there's a lot of market volatility, and then take that money and transfer that over into cash into your bank account at this point when the market is low, because again, you don't want to sell low. So that's where we recommend that if you can take money, if you have funds in an annuity or in CDs or in cash bonds, now would be the time to take expenses or to take withdrawals from somewhere that isn't down as much, that isn't beat up as much, and let your stock and stock market investments ride it out a little bit, and then start withdrawing heavier from them when the market is up and doing well. So right now, again, yeah, if you can cut withdrawals, now would be the time to do it. And most importantly, you want to pay attention to which accounts you're withdrawing from, and that's something that we really talk to our clients about, where we help them make sure that depending on what's going on, depending on stock market conditions, what can really make or break a retirement plan is which accounts you withdraw from and when you withdraw from them. So right now, something that we're doing is if there's people who are taking too much out of stock market investments, that means that we're selling shares at a low point to try and get that cash into their checking or savings account. We might want to restructure that and have them take money from a heavy cash position, bonds, or an annuity. So right now, yes, during the middle of times like these, if you can cut your withdrawals, you definitely want to do so.
Okay. Another one we hear is or observe is, people watching their accounts on their phone by the minute. Okay. How often should I be watching my account? First of all, before I answer how often you should be watching your account is, make sure you turn off the TV, because so much of our market right now is politicized from both sides, the left and the right. It's very hard to get economic information out there. We typically like to stay, if somebody asks us, where should I go to find out about stocks and about investments that isn't politicized, I like Market Watch. I like investing.com or investor.com or investor place. I mean, there's places like that. But when you start going to, the Market Watch and the Yahoo Finance, you're going to get a lot of politicized stock market information. So first of all, get away from, all of the bad news and look at just pure economic data and understand that, our market is still a very good market provided we get back to work here relatively soon. If the economy is shut down for 60 days and longer, yes, it's going to take a significant toll on the business and on the economy. People are saying on the news that there are going to be a number of businesses that aren't going to be able to make it through this. Well, unfortunately, that is the cycle of business, and some are going to come and some are going to go. Some are going to come as a result of this because there's new opportunities. But really, how often you should be watching your account? Definitely not days and weeks. We look at months and years. We tell our clients, please look at it from the most frequent should be monthly to analyze things. You analyze things on a monthly or an annual basis. At one point, the stock market was down over 30% here in 2020. And people have already gone to the point of thinking that 2020 is going to be, an absolute loss. It's only April. Okay, we have a long way to go. So, don't be reviewing your portfolio so frequently.
Exactly, Dean. That's a very good point there where many people, they're watching their account too frequently. One of the worst things that you can do right now is sit in front of your TV all day. It doesn't only take a toll on your mental health, but also your retirement account. Just because then you tend to make rash decisions, knee-jerk reactions, and you feel that you sit there, you watch it all day, and you might panic or think everything's okay when here you're not allocated properly. So oftentimes if you watch your account too often, that's when you're going to make those knee-jerk reactions. That's when you can completely throw off your retirement plan by doing that. So we do want to keep a long-term focus just because, especially in this stock market, things can change so frequently in one single day that you can't put too much weight on something that happens throughout the first 3 months of the year because anything can happen throughout the next 9. So that's where, again, we really reiterate taking a long-term perspective. We look at months, years, decades, not days and weeks. So keep that in mind. You don't want to watch your account every day. As we tell people all the time, it's only going to give you an ulcer if you do that.
That's right. Tyler and I were talking about this last week. We looked at some of our clients, and we enjoy our clients, but everybody has their own personality. And we identified 3 people within our client base that seem to be the most insecure about their investments. They like to make emotional decisions, which unfortunately are not good for them. And it seems to be they have one thing in common, and they're the most tuned in to TV each and every day. They watch every investing show out there. They watch both political sides. They are so in tune to what's going on, and they make the worst decisions. Some of our best investors, as far as their returns and their accumulation that they have over the years, and being able to set up their withdrawals in retirement, are those who constantly invest on a dollar cost averaging while they're working in their 401k. They put as much as they can in there. And then when they retire, they just make sure that they have a diversified portfolio. They turn it on and they go. So some of those people who take the emotion out of it have done the best. Some of those people that are so in tune to the market and so in tune to the economy and into politics have made significantly bad decisions with their portfolios.
Yeah, Dean, really good point there. That's something that we did notice. So again, the main takeaway there is don't sit in front of the TV and watch the news all day. Don't sit in front of your account and watch the account all day. Take a long-term perspective. Now, before we close out the show here, one of the last questions that we've gotten recently is people want to know what can they expect the market to look like yet this year. And Dean, you had just mentioned that we're only halfway through April. There's a long way to go yet. But and obviously no one knows, just based on everything going on with the virus and the closure of the economy. But right now we feel that companies' earnings reports and lack of a vaccine for the coronavirus and the unemployment will be a pretty big drag on the stock market over the next 2 quarters. So right now, at the end of the first quarter, we saw January and most of February was fine, but then in March, when a lot of the shutdown started, that's when we're going to see the numbers. However, we expect the second quarter and potentially the third to look even worse than the first, because now all of April, things are shut down, and it could happen into May and June, and that is the whole second quarter. So we feel that the next 2 quarters, the market could continue to be beaten up. If it will go past and set new lows, who knows? But then if we can get through this time where the virus levels off, or if we get a vaccine or some type of very successful antiviral treatment, then potentially toward the end of the year, we could show growth heading into 2021. But yet all that remains to be seen based on everything going on right now, just because there are a lot of unknowns. And one thing that the stock market doesn't like are the unknowns. So that's something that we have to keep an eye on. But ultimately, nothing is sure in the stock market.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.